as we look across the globe, valuations, whether in bond markets or in stock markets, are generally expensive. One area whereby there is value would be actually in Asia or emerging market local bonds. And that is because emerging market or Asian currencies are generally low or have depreciated over the years against the dollar. So they are considered cheap. These currencies have the ability to normalize and appreciate back to levels where they have been before. And that is an added source of returns for investors in the Asia local bond space. So what keeps me a bit worried at night is the Federal Reserve. The Federal Reserve, who have indicated that they're going to put interest rates up gradually next year and into the year after, as well as shrink its balance sheet. How that impacts the global economy and financial markets is critical. Because if there is any instability and volatility resulting from this removal of liquidity in the global system, and also the higher interest rates, I think we can generate a vicious cycle that causes a global economic downturn. The other risk, I believe, is more long-term, and these relate to the level of debt in the global economy. High debt levels in China, especially of corporate debt, and that high level of corporate debt will continue to rise because that has been the only model of economic activity generation in China. Government debt in the US, which has gone up as a result of the rescue packages that came from bringing the economy out of the subprime crisis, that can continue because President Trump now wants to introduce tax cuts, which would further therefore boost the country's deficit, and that will require more debt funding. So we need to contain these debts over the long term so that growth can be sustained. Otherwise, we get ourselves into another debt crisis, and that gets us into a deeper recession if these issues are not corrected over the long term. I think what we got right was a bullish call for credit markets generally. Over that 2017, what we are seeing is credit spreads coming in, and generally that has allowed corporates to basically outperform government securities. What we also got correct was our call to move into local currency, emerging market or Asian bonds. That has done well because post February 2017, the market has been able to gain from the fact that emerging market currencies have appreciated against the US dollar. Now, what we did not get as correct was our call on US Treasury yields. We have been thinking that it should move higher to about 2.80%, which is a distance from what we had anticipated. In 2018, the global economic expansion I expect to continue. I also believe that the Federal Reserve will begin to raise its interest rates and therefore bring its liquidity of its balance sheet down. That has the effect of bringing interest rates higher and also the credit spreads to widen. The third thing that I expect is that there will be a period whereby you will see the emerging market and local currencies gaining ground. And that is because a lot of the gains in competitiveness globally, especially in China, in India, and also in Indonesia, comes from the reforms that these countries have taken. I think the emerging market competitiveness should be able to help normalize the currencies that are currently at quite low levels, and therefore see the appreciation of these currencies against the US dollar.